Welcome to a special edition of the Telltales podcast, Cashflow Pick'em. In this episode, we'll go through the memo and pick which company we believe will grow their cash flow the most on a percentage basis. I'm Mike Nicoletti. Every week, along with my co-hosts Jason Wallace and Hunt Lawrence, we bring you the cash flow memo. Get it at telltales.us. For the next 30 minutes, we're going to dive deep into energy, technology, and healthcare. So download the memo now and get started.
The following conversation is intended for informational purposes only. You should always do your own work to determine if an investment is suitable for you.
We need to go through the 20 predictions made at the beginning of 25, so we want to leave enough time for that. Now, I think we turn the floor over to Jason. Mike and I forget what we predicted at the beginning of 25, but Jason writes it down, so Jason has the floor, and Mike and I prepare to be embarrassed by things we predicted that didn't happen.
Turning to page one, of those 5 companies, the largest growth in free cash flow, so not absolute, but a percentage growth, was actually Tesla, which was kind of surprising. That's who I picked. Mike had Amazon and Hunt.
I could hardly wait. What did Hunt pick that didn't work out?
You let us pick the tech companies. I think you did so well the year prior that you're giving us a chance.
Okay.
So the unexpected, or maybe, I guess the unexpected thing was the growth in CapEx for most of these companies was far in excess of maybe what anyone imagined at the time. So Tesla grew from $4 to $7 billion in free cash flow. So this year I'm picking Tesla as well, mostly because I think Apple had a growth in free cash flow. Everyone else spent way more money. I think this is the year Apple has to start spending as well to build the technology behind the new version of Siri. So I think Tesla is the only one that's not spending tremendous amounts of money on AI data centers.
I also picked Tesla, again, off a low base, and we'll see how robotaxi goes. If they actually get green-lit, there could be a lot more cars rolling off the lines that'll get employed in that fashion. And then the question is, how will that relate to cash flow? Is that going to be an on-balance sheet or off-balance sheet transaction? So we'll see how all that plays out. One thing that you didn't mention, Jason, is last year we also did picks using what were at the time barely usable AI agents, at least in comparison to today. So we had Grok and Perplexity as our 2 AI agents. So this year we will also do picks from Grok, Perplexity, Gemini, and ChatGPT. So we'll start to get a feel for if they're improving maybe year over year. And on that first page, just to close the loop on last year, Grok picked Amazon, Perplexity picked Amazon, and so did I. So I don't know. I don't know where that puts me. So Hunt, I'll turn it over to you, and then I'll give the AI picks.
I'm going to be a contrarian. I'm going to pick Amazon this year. I can't believe that they're going to continue to spend at the rate of $110 billion for CapEx and $90 billion for R&D. I think at some point the new CEO, Andy Jassy, has to create more discipline in the Amazon organization. But I might be wrong in 26, but I'll make the same bet, I think, or same prediction in 27. At some year, I'll be right.
Yeah. I think
free cash flow will go up, not necessarily from organic growth, but just from spending less capital on R&D and less CapEx.
And Grok and Gemini are both in the same camp.
The
other 2 AI agents, Perplexity and ChatGPT, also chose Tesla along with Jason and I. So that'll be a good one for next year.
So then on page 2, software companies, the winner, who was the winner here? ServiceNow was the winner with a 63% growth in free cash flow. Oracle, the big loser, turning positive free cash flow into a big negative with their spending. So who won that one? None of us picked ServiceNow.
Not even the AIs. So
The AI picked Snowflake and Salesforce. I picked Oracle. I'm the big loser. Yep.
What about this year?
So this year, my pick is Broadcom, generating a lot of cash flow from making TPUs now that Google's licensed that out to allow other AI providers to buy those chips.
And I picked Snowflake as we get into the actual building of tools with these AI agents. Snowflake will become more important. That was the premise for my pick last year too. On the AI front, Grok and ChatGPT both picked Snowflake, and then Perplexity and Gemini picked Broadcom. So now that you have all the intel, what do you think?
Yeah. I'm impressed. I mean, ServiceNow, it seems to be growing faster than Salesforce, and they have free cash flow, which, is pretty minimal. Snowflake. I understand Jason's pick of Broadcom, but I think I'm going to go with ServiceNow this year. I think they're just outperforming the other companies that are trying to develop AI applications for their customers.
Turning to page 3, chip manufacturers, semiconductors. Obviously, the big winner was Nvidia. They weren't that far ahead of ASML, which was a little surprising. Mike, along with the AI agents, all picked Nvidia. I picked Taiwan Semiconductor, who's, again, my pick this year as the single bottleneck in the whole semiconductor manufacturing space. And they're finally deciding to increase pricing.
I picked NVIDIA again. This is mainly only because I think Taiwan Semiconductor is going to chew up a good chunk of that cash flow with CapEx. They were planning for $53 to $56 billion CapEx in 26. They could probably do 30% more than that and still not meet demand. As far as the AI agents go, AMD was a favorite with Grok, Perplexity, and ChatGPT all choosing AMD. That is also indicative of a shortage in semiconductor availability. And then Gemini chose Intel of all companies, which actually did relatively well year over year, going from negative 17 billion in cash flow to negative 6. And some green shoots are there for what's happening on their Arizona fabs. The downside is the only reason that's really happening is because Taiwan Semiconductor isn't spending enough.
Right. Yeah. I'm inclined to go with NVIDIA. I know I am skeptical that they can maintain the free cash flow margin relative to sales. And there's certainly many, many people thinking that sales revenue will flatten out. And it's perfectly logical to think they're going to flatten out. There's the Google competition with GPUs, and Amazon has their own chip. I just think Jensen's probably right for another year that compute is really an inference for applications is really scarce. And that's going to enable them to run their sales from the 200 billion range up to, 280 or something, really substantial increase. So that'll certainly bump free cash flows.
Yeah, you guys may be right. So the run rate going forward from their last quarter's report is super strong. On page 4, the media companies, the winner last year was Spotify. And then the only other one of those to grow free cash flow was Netflix. I chose Netflix along with one of the AI agents. The other agent chose Meta, and Mike was the winner picking Spotify.
Wow.
This year, I'm swapping to Spotify as my pick. Netflix, I expect Netflix to have a strong year, but they've indicated they're going to ramp up spending for productions and the whole Warner Brothers thing.
Yeah, I'm going to pick Netflix. This may not work out real well, but for the sake of doing something different. Perplexity is with me on Netflix, and Grok and Gemini are with you on Spotify. ChatGPT's picked Disney. So, Hunt, where do you land?
I can't see I can't see anything but Spotify increasing their free cash flow this year. I mean, Meta is just drowning in capital spending. Disney, I know Jason's been more right than wrong on Disney, but it just seems to me they're challenged. Netflix is, if we're running a poll on stock performance this year, if that Warner deal goes through, I think Netflix is kind of a lock to have the worst stock performance this year. I just think it is a poorly conceived transaction for Netflix that they shouldn't need to do. And they become levered up. And, the flip side of that is if somehow from an antitrust point of view or somehow Paramount topped them with their cash tender offer, that would be very bullish for Netflix, I think. I'm gonna go with Spotify.
All right. I'm surprised no one picked Meta. I think if Zuckerberg just decides he's not going to spend incredible amounts of money on the metaverse and all that,
it could change.
He has an
quickly.
easy win. Yeah.
No, I think Jason. I think Jason's right. I just think Spotify is so disciplined. I'm just really impressed with them. As compared to Meta, which is kind of undisciplined.
Exactly. We combined page 5 and 6. So out of those two pages, the winner there was Comcast, growing free cash flow 13%. No one picked them. Mike and I both picked T-Mobile. The AI split their decision between T-Mobile and AT&T. This year, my pick is going to be AT&T. Kind of a thesis we've had for years from our Dish EchoStar position was that you'll be able to leverage a radio access network in the cloud, which should give them higher margins on operating their network. So AT&T is the only other one that signaled they're going to do that.
I chose Charter mainly because they've signaled that they're going to be spending less in CapEx in future years. And I think the others on this page still have pretty robust CapEx plans. So not really a growth thing here, really just a reduction in spending. As far as the others go, Grok also picked Charter, and that's the only one I have on here. So I must have not written those ones down for the other AIs.
I continue to be impressed with T-Mobile. Now it's come down a lot, and I guess their execution is disappointed. Something's happened, but they seem to, they don't have, it's very interesting. They trade a 2% yield. Verizon's a 7% yield, and AT&T is just under 5% yield. They don't have as much debt as AT&T and Verizon. They just seem to be doing it better to me. I don't know the field anywhere near as well as Mike and Jason do. So between Mike and Jason and me, I'd go with them at AT&T, but I'm going to pick T-Mobile.
Got it. Moving to page 7, the payments companies. PayPal was the winner last year. They grew free cash flow 12.5%. Who picked them? Mike picked them along with Grok. I picked Visa, and Perplexity chose MasterCard. So this year, my choice is going to be Visa, sticking with it. Where are you, Mike?
I've got PayPal again. I'm going with the agents, the AI agents, Grok, Gemini, and ChatGPT. All picked PayPal, and MasterCard was the pick for Perplexity.
I think it's hard not to go with PayPal. They've got the most potential for improvement, I think.
Retailers on page 8. This was kind of a sad group. They all had shrinking free cash flows. The winner by shrinking free cash flows the least was Walmart with a 1/3 decline. CarMax had quite a dramatic decrease, turning to negative free cash flow. The AI agents both chose Walmart. I chose CarMax, and Mike chose Home Depot on this one. So going forward, my pick is going to be Walmart. I forgot my reasoning at this point, but but that's where my pick was.
A bounce back, maybe. I picked Home Depot. I think there's something to, what did I say earlier, Jason? They used to say, don't fight the Fed. Say, don't fight the White House. The White House wants us to build more homes. And if more homes get built, that's probably good for Home Depot. So don't overthink it.
I asked Mike if that, when he said that, does that mean the White House is the Fed?
I'm a long-suffering CarMax stockholder, and they are way underperforming where they should be. So I guess I'm going to bet on a CarMax turnaround to go from a negative to a positive number. That'd be my bet here. Gee, we're up to page 9, and we're down to only about several minutes left. Exhibit C, no particular change. Mentioned last week, Venezuela doesn't impact this. It's under 1 million barrels a day and 100 million barrels of supply. Saudi Arabia is up. U.S. at these oil prices is a fair prediction is down by 500,000 barrels a day, 13 to 12.5. The surplus capacity, which might have been over 4 million barrels in 24, will be down within range of 2.5 million barrels, maybe less in 26. It's basically a function of supply. I don't think Iran is going to be able to go up from last year. I don't think sanctions coming off Iran are very likely. There's a little bit of increase from the UAE and a little increase from Iraq. Russia about flat at, say, 700,000 barrels down from their peak. So the impact of lower oil prices are being felt. To think that the oil price would trade WTI much more than 60, I think it's unlikely. The refrain in the industry is often that Trump wants $50. I don't know that Trump is going to get $50. I think something in the high 50s, low 60s looks sustainable, especially with OPEC Plus, which includes Saudi Arabia, Russia, Iraq, and UAE, committing to not increase production during the first quarter, which will last through March. I doubt if we'll see any increase in production from OPEC Plus in the second quarter either. In terms of demand, the U.S. is flat. Europe is flat. That's no surprise. Japan is flat. China continues to be down. At our forecast for 26, Jason bravely said he thought that China oil consumption would pick up. That would be very helpful if their production in 26 stops going down. It's the last 3 years gone down about 200,000 barrels a day. Look at 26. I mean, just to show the impact of China, we're the largest oil consumer at 20 million barrels, but they're fairly close behind at 16. That's bigger than all of Europe. That's especially bigger than India. Everyone thinks, oh, India's the future. Well, India's only 6 million barrels. So, if China flattened out or started up, that would be very important. Impact on oil pricing. Exhibit B, the oil price last Thursday was 60. The 26 price is 59. I think this week or the next, I'll have to start adding a 27 price. The one that's changed a lot on this page is gas. Gas, as of last Thursday, for 26 delivery was $3.30. That number was well in excess of $4 just a few weeks ago. What's happening here is supply has already reached the 108 that this estimates for 26, and it's only January. Power demand is, despite all the talk about data centers need more power, power is going to come from gas. Gas demand to make power is down as compared to the last 4 or 5 years when it was up every year. The great hope, of course, is LNG, but with all the projects that are under construction, we're definitely going to use more LNG every year. But the problem with the LNG market is it can get oversupplied. We are now, I think, the largest producer of LNG, which is quite an achievement. I think second largest is Qatar. Qatar is unlikely to see much in the way of market share to us. They'll continue to bring their production on. So if we got rather than a $9 price for LNG into Europe, if we got a $6 price, would that have an impact on Henry Hub? Gas pricing in the U.S., yes, it would. Would it go down in an equivalent way, if LNG is down $1 and Henry Hub is? No, I don't think so, but it will have an impact. It's not a plus. That gets us to Exhibit A. Once again, the government runs out of funding at the end of this month, but to their credit, the House and the relevant Senate committees have gotten through most of the expenditure bills. We will have a budget. The budget is supposed to be done before the fiscal year starts. Fiscal year starts October 1. So ideally, the budget of 12 bills that encompass the money the government spends should have been done in July or August. But this is the first time in a long time. I'll have to check how long, where we will have completed all the expenditure bills. So I don't think a government shutdown is likely to happen. And the healthcare discussion will continue, which is what the prior shutdown was about. But it is gratifying to see them finish, as they call regular way, actually passing the expenditure bills, even though if there's the better part of 5 months late, it's still gratifying to see it happen. I know we get criticized when we don't do any healthcare. I think that means the listeners want to listen more to Jason than they do to Mike or myself. But why don't we continue with page 9 next week, and then we get into the energy things. Then I'm more knowledgeable. And why don't we hear a catch up on healthcare with Jason, and then we'll start with the oil companies next week.
Yeah, I don't have too much news to report. JP Morgan, the healthcare conference that occurred, there was not as many deals announced as kind of expected. Some analysts are expecting companies are shifting focus away from the JP Morgan to some of the other healthcare conferences that happen over the next couple months. I don't have an opinion on that. Some of them, as far as pharma study data coming out, a real positive was announced recently this week. Moderna and Merck had a trial. It's a phase 2 clinical study for a cancer vaccine for melanoma. So in this study, patients were giving a Moderna cancer vaccine after being treated with Keytruda. And in this study that looked at the patient journey over 5 years, so kind of a long time, it's a long time to collect data, they had a 49% decrease in the likelihood of reoccurrence of that cancer. So pretty big impact, something Mike and I have been looking at for the better part of a year now. Great that this study resulted in this. And then going forward, Moderna and Merck both have a number of other studies, similar designs for lung, bladder, and kidney cancers. So very positive early indication out of the melanoma study.
Jason, I normally have a healthcare call on Wednesday mornings, but we didn't have it. But Illumina got CMS reimbursement for genomic oncology tests. So Illumina is not a company we talk about a lot on this podcast, but it's a company that's very interesting from the genome sequencing perspective and kind of the way things are changing in diagnostics. So,
and our intern Montana helps us out a ton on this area.
Yeah.
What about the weight loss drugs? They're coming off patent, I guess, and so there's generic competition. But is Lilly better positioned than Novo to look with that, or what's your take on that, Jason?
I think they're better positioned from the new drugs that are. Lilly's is still pending FDA approval, but the new pill forms of the drugs, Lilly should be able to produce theirs at a much higher margin than Novo Nordisk. So that positions them well. And yes, the current slate of GLP-1 drugs are coming off patent over the next couple of years. I believe the patent in the US extends out maybe 2 or 3 more years, but they start rolling off patent in places, I think, like Canada and some countries in Europe this year. So there's going to be a lot of pressure from generics.
Not to mention the pressure from all the other options that one has now.
Right.
So.
Right. Is the secret to not having to give yourself a shot, but it's something you can take in a pill? Is that breakthrough? Whoever gets there first will have an advantage, or how do you read that?
I don't know if it's so much of an advantage. Novo Nordisk is first. Theirs received approval 2 or 3 weeks ago. So very recent. I don't know if it's on the market yet, but it will be very shortly. I think it's the same. They beat Eli Lilly to market for the injectables, and then Eli Lilly had just the better product in the end, and that took the lion's share of the market. So I think the same thing's going to happen here. Eli Lilly's they'll be able to undercut on price. Whether they choose to is a question, but profitably they'll be able to sell a lot of these prescriptions, and probably direct to consumer.
What do we think of cancer vaccines? I mean, presumably that's what Moderna has with Keytruda and Merck, and you're talking about it having applicability to other cancers. I mean, is there some kind of a breakthrough happening? What does this mean for Moderna, BioNTech, healthcare, combating cancer, and how much progress on cancer can be made in a 1, 2, 3 year period with these cancer vaccines?
I think we'll see. It'll be the appearance of a lot of progress being made, but I think really they've been working on this for a long, long time. The way we see cancer vaccines fitting into the market is it won't replace treatments. It won't replace, obviously, surgery. You're going to have some sort of precision targeted drug as well. And then once you've followed a full course of treatment, we think you're going to be continually tested for DNA fragments of the tumor if they are still circulating in your body, or just looking for that to reappear. And you will be given one of these cancer vaccines, and that's going to prime your immune system for that specific form of cancer that your immune system's ready to fight those cancerous cells if they reappear. If the mutation that caused that spontaneously happens again, and then a tumor starts growing, your immune system will be able to knock it out. The thought is your immune system will be able to knock it out before that grows into something that's significant and a health problem. And we do feel that this data is proving that to be true, and following that logic, at some point after you receive a course of treatment for any cancer, there's probably going to be a follow-on vaccine that primes your immune system to look for those tumors that may start growing again.
Right.
So it's really an add-on. It's going to prevent reoccurrence. So it's the anti-relapse portion. It's still not it won't be a replacement to any treatments that you receive. Now there are a lot of advancements on how we're treating cancer as well, and they'll be coming on market in the next couple of years as well.
Most of these tests, Jason, the trials are being done on patients that have already been treated for cancer. Do you think that they will be given prophylactically to people that are statistically likely to experience those cancers?
That's a good question. Maybe certain cancers, maybe something like breast cancer, that's much more common and well known what the mutations are. But I think in general that probably won't be the case. It'll be not wanting to overtreat, and you can't vaccinate for every form of cancer. So I think it really will be, maybe we step up our monitoring. There's
that's the other side of it, right? Is that you could do MRD testing before knowing that somebody has something. And as those tests get better, we may be able to do a really interesting diagnostic on a healthy person that could get us ahead of the curve on some of that stuff.
Right. There's companies like Grail that are doing these kind of broad-based monitoring for or early detection of many forms of cancer. So I think that becomes more commonplace. Right now, it's still a debate on whether you want to test people up front, and there are false positives, and they'll lead to overtreatment in some cases. I think, and also they don't want to scare people that are either in early stage or it is a false positive. But I think we get past that, and I think if there is a positive test, you just retake a test or two. And the price of these things are coming down dramatically, so we'll be able to provide these tests. Right now, I think a Grail multi-cancer test is $800 or $900. The price will keep coming down. It'll be something that we probably just do every year.
Yeah. The future of healthcare is very diagnostic driven, but less physician driven.
Good. Well, you've run through our extra 4 minutes or so. Everyone be well and stay healthy. And we'll be here 7 days from now to complete the cash flow predictions. And in the meantime, thanks very much for listening. Take care.
The views expressed on this podcast are the host alone and do not constitute an offer to sell or a recommendation to purchase or a solicitation of an offer to buy any security nor a recommendation for any investment product or service. While certain information contained herein has been obtained from sources believed to be reliable, neither the host nor any of their employers or their affiliates have independently verified this information, and its accuracy and completeness cannot be guaranteed. Accordingly, no representation or warranty, expressed or implied, is made as to, and no reliance should be placed on, the fairness, accuracy, timeliness, or completeness of this information. The host and all employers and their affiliated persons assume no liability for this information and no obligation to update the information or analysis contained herein in the future, and may or may not hold positions in the securities mentioned.